Yeah, so around the book and in China, but not much. And we haven't done a book tour or anything like that. But now we have this ETF listed on the New York Stock Exchange. So anybody can actually, use our approach to investing if they want to, and if they're able to buy US listed ETFs. So we changed the asset allocation, according to expected return and riskiness. Yep. So we're doing exactly what we talk about in the book or in our. My wife and I, we had dinner with Chifu and Marina last night. They live out here in Jackson Hole part of the year. Isn't that
Yeah, I know
crazy?
that they spend quite a lot of time a year, over there. Yeah, so
Yeah,
you
yeah.
still kind of connect with the ex-LTCM.
Yes, yes, still very friendly with most of my partners. Yeah.
欢迎收听珠峰洞察，这是一个聚焦全球金融先锋思维与亚洲前沿资本洞察的对话空间。我是李红，珠峰资产的创始人兼节目主持人。我在金融行业的旅程始于近30年前的对冲基金长期资本 LTCM， 而今天的嘉宾 Victor Haghani 正是我在 LTCM 的前同事，当时他是负责欧洲业务的合伙人。本期节目我将与 Victor 一同探讨 LTCM 的经验教训，他所著的《The Missing Billionaires》一书中的财富管理原则，以及如何在资产配置、流动性管理和跨代财富传承中的洞察。如果您正在规划高净值家族的资产路径，评估另类投资的价值，或者是思考如何构建长期可持续的投资组合，那么这将是一场既睿智又真诚的交流。让我们正式开始。Victor, it's been quite a journey since we first crossed paths back in LTCM office in Greenwich. I still remember the stretch in 1997 to 1998 when you flied in from the London office. You were the partner leading the European side, and I was a young quant, just absorbing everything I could. After the LTCM fallout, I spent time at Goldman Sachs, co-founded UpHedge and later Sycamore Investment Services, and continued down the road of asset management and also wealth management, especially in Asia, in the past 15 years. Eventually founding Everest Strategic Asset Management to serve high net worth clients in Asia. You have taken a fascinating path yourself with Elm Wealth, building a wealth management firm that reflects your distinct philosophy on risk, allocation, and behavioral finance. I have read the book, The Missing Billionaires, and I have to say, it is as provocative as it is practical. I'm excited to reconnect today, not just to reflect our lessons learned from the past, but to explore what they mean for investors now, especially in the world of liquidity puzzles, sizing challenges, and the evolving role of alternatives.
So the first part, we would like to maybe briefly review on the lessons from the LTCM. So you were at the heart of LTCM European operations. What was the early warning sign you saw before the collapse?
Well, yeah, I think that the early warning sign, looking back at it, was, going through a period where the return on our portfolio started to be like a small negative, but day after day. So, it wasn't very disturbing in terms of the total losses that we were experiencing, but, it was a very unusual and subtle pattern of mostly small daily losses across the board. And I think that, it's hard to evaluate whether, that was really an early warning sign or I'm just thinking about it with the benefit of hindsight. But with the benefit of hindsight, we know that what was going on was that there were large liquidations that were happening in particularly in Citibank, where Citi took over the former Salomon Brothers arbitrage desk, and Jamie Dimon, who was really running the show at that point, working for Sandy Weil, decided that with all the turmoil in the world, that they wanted to reduce a lot of those relative value, highly leveraged investments that were there. And so that started that June, in May or June, certainly by July and August of 1998, it was those small daily losses that I think should have been more concerning to us than they were. That was probably the early warning sign, I think.
So you mentioned about, Solomon Brothers that time kind of liquidate that kind of prop trading, which is a very similar strategy as LTCMs. So what about the Russian defaults? Is there any kind of hints, any kind of sign from that as well, kind of causing the some of the liquidity crunches?
Well, I don't really think that was an early warning thing, like that when Russia defaulted, which was quite a, which was a tremendous surprise to people. Not that they defaulted, but they defaulted on their domestic debt and did not default on their dollar and foreign debt. That nobody saw that coming. And once that happened, then we were in the middle of it. So it wasn't anymore an early warning.
Mm,
Once they defaulted, that was then we were, very close to the middle of the whole thing at that point.
right.
So, and I think that once we were in the middle of the crisis, then, we made a decision that, in retrospect, turned out to be the wrong decision. Once we were in the crisis, we were like, okay, so many people wanted to invest with us. Let's get them to invest with us now. And we got a lot of interest, but it just became an always moving goalpost that we weren't able to get across the finish line. The finish line just kept moving away from us as we were
Hmm.
raising money. And I
Right.
think that, with the benefit of hindsight, when we were in the crisis, we should have called together our major counterparties and said to them, like, we'd like to reduce our exposures by 50%. We want to sell your 60 or 70% or whatever. And, I think there was a moment in time after the Russian default, but before the end of the whole thing, when we could have done that, but
Mm,
we let things drag out. Goldman Sachs was trying to help us, but they were kind of conflicted. And the whole thing was, we didn't really, manage that process and we didn't really make the best decisions or manage the process that well. And, at the end of the day, we were thinking that, look, the investors with us that we had, are all investing a small amount of their savings with us, that we weren't managing, that we didn't have investors where they were like, okay, here's 90% of my savings to put into your hedge fund. Like all of our investors were very, institutions or other investors that had a lot of capital, and they were giving us a very small allocation of their total. So we thought, well, we have to do what's right for them. Like if we lose 100%, it's going to be bad for them. It's a loss. It's a lot of money in absolute terms, but they wouldn't want us to just sell everything and stop. They would want us to try to hold on to these positions. And so we really tried to behave in what we thought was in the best interests of our investors, and which was not really in the best interest of us or of the overall system either. I think again, just looking back, I think that we should have done things differently. But anyway, we were in a very institutional business, right? I mean, this was not a retail. This was not something that people used for their retirement savings, and it wasn't something for individual investors. It was something where banks and endowments and so on were the investors, and they were very sophisticated and small allocations to us overall. There was one investor that was very big, which was UBS, but that's a separate kind of story and a special situation.
Yeah, it's kind of amazing when I look at the loss from the investors, later. It seems to me, well, I mean, certainly from the fund perspective, there's a big loss, and also a lot of partners, kind of lost their money. But in terms of number of investors, kind of lose the money, it's actually not that many. And also, the biggest loss from is probably just a few institutional
Right, right,
investors.
our typical investor, most of our investors made like a 20% return because they invested with us in 1993 or 94. We returned all of their capital to them. Sorry, we returned all of their profits to them in 1997, which was more than their capital that they put in. We left them either with their starting capital or in some cases a little bit less. And so as a result, the IRR that they earned was like a 19% IRR or something like that because of that huge redemption when we were trying to we wanted to be smaller. In 1997, we thought, our positions are too big. We don't want to grow anymore. And so we tried to reduce everything. We again, in hindsight, I think we should have raised more capital and made the position smaller would have been better. But anyway, that's right, that most of our investors actually made a good return, even though at the end they lost, this thing that they had left in the tail piece of it.
So I remember I talked to a few of them, yeah, the investors. in the past several years, and then they were asked to redeem, in 1990, early 1990, late 97,
97, yeah.
right?
Yeah, yeah.
So they feel a little bit
Yeah, they weren't happy. Yeah, they weren't happy when we were sending the
right,
money back. They were mad at us. But then, so
yeah,
they and of course they were mad at us that we lost what they still had a lot of money with us and they lost that, but lost a lot of it. Not all of it. I think it was like a 90% drawdown at the end in 1998. But yeah, anyway, so yeah, it's a long time ago.
yeah. But what
Yeah.
about
Yeah.
the risk model? I thought we had a so-called almost the best risk model, right? So many people kind of invented. So why did the risk model fail to capture the tail events? I mean, what did we really miss?
Well, I mean, first of all, I don't think that we would have said that we have the best risk models. I think that we would have said that we had very good valuation models and that we had a lot of experience also in the microstructure and the institutional detail of the different markets in which we were trading. So when we traded mortgage-backed securities, we had 50 years of experience. We had people that had 50 years experience, in that space. And it wasn't a model, we weren't like running models and deciding what to do. The models were there to help us to identify things to then think about from an institutional point of view. So, I would say that, we had good models for valuation. We had a lot of institutional experience in terms of the microstructure of the markets and the segmentation, the supply and demand characteristics. And from a risk point of view, we recognized that what we were doing had that all financial assets have fat tails, that's just the nature of financial assets, that, all, whether it's stocks or anything, has fat tails to it, that's not normally distributed. So we knew that. We told investors, that they shouldn't think of our returns as being, normally distributed, but that there would be fat tails and that there would be outsized losses from time to time. I think that what we failed to kind of recognize was that having all these different counterparties that we had, that if we lost, say, 15% or 20%, something in the vicinity of a loss of 15 to 20% was going to, make people think that there's a good chance that we're going to have to liquidate everything, that would be typical for leveraged hedge funds at that time. And then that combined with how many other players wound up having positions similar to ours. So the dynamics were different than they were when we were doing it at Salomon Brothers, I would say. And, I think that we underappreciated those effects. But, in some sense, we always recognized that our returns would have very fat tails and that. And of course, we recognized that we could lose everything. We were running leverage. I mean, that, we had seen other leverage players, lose everything. And we thought, though, that, net, it was a good return distribution. That we had. So, I wouldn't say that when we, that our reaction wasn't, wow, this was a 1 in a million year event. I mean, it was more like, wow, that was, a 1 in a 50-year event. And that was unfortunate that it happened to us at that time and that we managed it in that way. So,
right.
I think that, but I wouldn't say that, like, I don't think that we had particularly sophisticated risk models. I think they were just, they were best in practice at the time. That's, it was the best, we were operating with best practice risk models, at the time. And when you're running leverage and doing relative value trades, that there's always, a lot of tail risk. And today is the same. So, I think that anybody, hedge fund today, that is running leverage, a fair amount of leverage, whether it's in fixed income or in equities, no matter what their risk model is, that they have a chance of going to zero if they don't have the liquidity to reduce everything right away. So, that you might be operating like a lot of macro funds or multi-strat funds, they'd have stop losses. If you lose 5%, you take off half your position. If you lose 10%, take off all the position. And all the positions are monitored to make sure that there's enough liquidity so that you can do that. And if that works, right, then you're not going to lose 100% of your capital. But, that's not generally how relative value is run. And, liquidity is much more volatile than price. And so,
That's
that
right.
liquidity, so you can think that there's enough, like we thought there was enough liquidity in all that we had, but the liquidity quickly dried up. The liquidity went down by over 90%, maybe by 95%. So what we were planning on doing, we weren't able to do. Plus, once we made this decision that we were going to try to raise capital,
Right.
actually we could have sold, I think we could have sold the entire portfolio, 20% below the mark to market or something. I don't know. Is that speculating? I don't know. But so anyway, I think that's just the nature of leveraged investing.
Right. So I think, from the name of the company, long-term capital management, right? So it seems to me someone already thought about the liquidity constraint or potential impact to the fund's performance. That's one. The terms on the redemption and also the lockup, it seems to be pretty rigid as well, right? So I guess people thought about this upfront, but when the event really happened, the real world is probably a lot more different. So that gives a question about the sizing and also the concentration risk. From your personal lessons, did you take away from this experience?
Well, I think that there are many lessons that we learned and that other observers of the situation learned. It was a very dramatic and impactful set of events. I think that a lot has been written about it. There have been books and articles, and HBS, the Harvard Business School, did a case study on it. There's been a lot that's been discussed and learned. I think that one thing that didn't really get discussed that much, was that ultimately the partners of LTCM, that the partners had we all had quite a lot of our own savings and personal capital invested because we felt that it was beneficial for our investors to see that we believed in it. We thought the returns were good. We also felt that we were close to it, that we didn't have to charge ourselves fees. So it was, more attractive than for others. There were some tax advantages, in the structure as well. I think that for my part, anyway, personally, that I had too much more invested there than I should have. And so it was really a very strong lesson in diversification and concentration, that at some point, no matter how bullish you are on something, that the risk of it, means that you need to be diversified, that even when you find something that's extraordinarily attractive, in fact, the more attractive something becomes in a way, at some point you want to own less of it because it's so attractive that you can already say that I'm quite wealthy because I found this gem that's so attractive. I'm already really wealthy. I don't need to even do more and more. And then, anyway, we've written about that in our book. We've written about both LTCM in our book. There's a whole chapter on it there, chapter 8. And we also talk about, just scaling and concentration and that sort of thing. So I think I think those are really good lessons for everybody in terms of thinking about, whether you're an entrepreneur, whether you're an investment manager, whatever it is, that, thinking about how concentrated you are in what you're doing is a really important thing to think about and to try to limit to some degree because, it's great when it all works out, but, it's really, it's terrible when, you lose your job and you lose your savings, and all of that happen at the same time.
Many of our clients are kind of entrepreneurs, in China. So they make their wealth from what they're good at, taking the risk, building a business and list a company and IPO and all. So they make a lot of wealth from there. But at the same time, in terms of managing the wealth, it's a very different game. So I guess later we'll talk about, your book and also your thought about the wealth management. Because in the wealth management, the diversification, global kind of asset allocation, managing this different type of risk becoming even more important so that people can have their wealth being kept and also passed to the next generation. So maybe we can talk a little bit about your book, The Missing Billionaires, Rethinking Wealth Management. One point, I think Soros said that it's not whether you are right or wrong that matters. It is how much you make when you are right and how much you lose when you are wrong. And then your book talk a lot about the poor sizing decisions and not the poor investment, the real wealth killer. Can you unpack that?
Yeah, I mean, ultimately investing is there's two decisions in investing. There's what you like, what you want to invest in. There's choosing or selecting. There's the what decision, selecting what you want to invest in. What are the things that are going to perform well, in your opinion? And then there's the how much, that it's not enough to decide what you want to invest in and to select what you think is going to be good, but you also have to decide on how much to invest in those things. Almost the entirety of what we read about or hear about or watch on TV and financial press is all about the what decision. Are Chinese equities good now, or is it not a good time for Chinese equities? Or, Is it a good time for to own fixed income, or is it a better time to own real estate or whatever? Is it a good time for gold or Bitcoin? And it's just all about the selection decision. And the selection decision, ultimately, if you just always select the wrong things, then things are not going to go very well for your savings. But even if you select the right things, but if you get the sizing wrong, that either you don't invest enough or you invest too much in those things, then you can also have a very suboptimal or tragic outcome too. So the sizing decision is as important, I would say, as the selection decision, but it doesn't get as much attention. Also, the selection decision is competitive, that your decision about what you want to buy and own, is really that in many cases, if you're right, somebody else kind of has to be wrong, depending on what you're doing. Like if you're doing alternatives or stock picking or private equity, I would say that you being right kind of means that somebody else was wrong because you made concentrated bets. You wasn't just the market portfolio. But in any case, the selection decision is really difficult. But the sizing decision is not something where if you're right, somebody else has to be wrong. Everybody can be right together. It's not difficult. It's not competitive. It's not zero sum. And so, we should focus more on it to try to get it right. Ultimately, sizing depends on three things. It depends on the expected return of the things that you're going to invest in, the expected return of stocks and fixed income. You have to have some idea of what the expected return is of the different things that you're considering to invest in. There's no avoiding that. You need to have some idea of expected return. You have to have some idea of expected risk, the distribution of outcomes. It doesn't have to be a standard deviation or something like that, but you have to have an idea of how risky things are. And then finally, you have to have your own personal degree of risk aversion to combine with those to decide how much you want to have of those risky assets in your portfolio. And so it's not very difficult. It's really three inputs. I mean, I don't think that it makes sense, that it doesn't make sense to be able to invest in anything if you don't know its expected return. I think that, the whole idea of, I'm going to have a 60-40 portfolio somehow is like, trying to avoid the whole question of what's the expected return of stocks and bonds and treasury bills and whatever. It's trying to put that to the side and say, I'll do 60-40. Well, 60-40 is a nonsensical thing without reference to what's the expected return, what's the risk, what's my risk aversion, So that's really the asset allocation decision ultimately is down to those things. So that's really the heart of our book, where, we say, well, there really aren't any other books that we're aware of that are written about the risk-taking, the sizing decision, that our book is about how much to invest in these things, not about what to invest in. I mean, we have a chapter that talks a little bit about what we like to invest in or how to think about different things, when you're trying to build up those expected returns and risks. But the bulk of the book, 24 out of 25 chapters or whatever, are all about the how much question.
I'm kind of wondering if the wealth manager or the wealth advisor is kind of responsible for advising their clients for all of these asset allocation decisions. So in future, do you think the AI can potentially do most of that? Because it seems to me different kind of advisor have different kind of skill, and then the background is very different. And then learning about these complicated subjects may not be so easy for them.
That's a really interesting question. I mean, I think that as many successful investors have said that, investing is pretty simple. And so, it's pretty simple. It's pretty, what does Warren Buffett say? It's simple, but it's not easy. What he means by that is it's simple, but it's hard to be disciplined.
That's right.
So I don't think there's really any role for AI in the wealth management, because, I think that we just need wealth advisors that, I think that the humans can do a good enough job that we don't need the AI. It's so simple that we don't need the AI. It's just like, okay, look, I'm a wealth advisor. What am I saying? It's like, okay, let's keep your costs down. Let's keep your diversification up. Let's keep your taxes down, and let's not chase returns. So and let's keep things liquid and transparent and so on. So as soon as if you just say, if you say that's what I want to provide as a service to wealth management clients, then it's like, you're almost there, that you've gone 90% of the way to a wealth management solution. So Now, if I guess it depends on what somebody believes is the right, investment program for clients. So if somebody is like, well, my suggestion is don't worry about fees, don't worry about taxes, don't worry about diversification. Let's just buy whatever has done the best over the last 10 years. Well, that's a different model. I think that's really a bad model. But I don't think that we need AI in here. I think we just need people to think about what's a good model and then to just deliver it, because it's not. Now, I think where AI can be really useful is in financial advice to very low income people. So, there's so many people in the world who don't have any, who basically they have, the equivalent of $30,000, $40,000 of savings. They keep the savings in, in a bank that pays them zero interest or close to zero interest. They have credit card debt. They have debt on their car. They bought a car with a car loan. They have credit card debt. They have a trailer home that's in a trailer park where they don't own the land. And if they talk to a financial advisor, the financial advisor would say to them, okay, this is what you got to do. You got to get a smaller car. You got to get out of the trailer park and buy a house where you own the land. You got to get rid of your credit card debt, and whatever you have left over, you start to put into a global stock market index fund. Okay? That's what you need to do. But nobody wants to talk to that person. The wealth advisor doesn't want to talk to that person because there's no money there at all, right? It's like quite expensive. Also, that person it's not just that conversation. It's that even if a wealth manager that could say all of that to that person, like that person wouldn't listen. It's like a longer process of interaction. And so, I think that some kind of AI plus human combination, could really help lower income people with making much, much, much better financial decisions that would have tremendous impact on their financial future. But so I think that's where the AI can come in, because then the AI can make it possible for somebody to provide financial advice to somebody for $50 or for $100 or for whatever, But right now we can't afford it. That person can't afford to get good advice. So there has to be some solution like that. But I think for higher net worth people, I don't really see the AI. I don't see AI as being that helpful. I think we can do it just fine. Whatever the model is. If the model is low cost, low tax, high diversification, we can do that. Or if the model is something else, like let's invest in hedge funds and private equity, you don't need an AI to do that. You just need a person that thinks that that's the right thing to do.
Yes. Well, in China, in Asia, we have a lot to learn, a long way to go. I used to work for a second largest fintech company in China. It's for the clients are the mass affluent, white collar, middle class clients. So we provide the online wealth management services for them, develop different kind of model portfolios so that they can actually invest with a smaller amount of money in the portfolio of ETFs to achieve the goal. And then in using all the fintech techniques to kind of help them to get interest in certain subjects, and then to eventually get into investment in the proper way. And then later I worked for the private wealth management company. It's the largest independent private wealth. So they're servicing the high net worth individuals in China. So this too is a very totally different approach. The first one focuses a lot of liquid assets, ETFs, the primary constituents for their portfolio. And then the second one, we introduce many alternative investment, which are illiquid, a lot of private equity, real estate investment funds, infrastructure and hedge funds, not that liquid. So the minimum investment amount is bigger. And then the second one is actually rely on heavily on the human. It's a very high touch human kind of services. And then the first one is pretty much interaction. It's pretty much all machine. So I guess, to your point, for servicing the mass affluent or the lower income people, applying the AI and applying some sort of robo advisory approach could be pretty efficient.
Yes. Yeah.
So the book you also mentioned about you had an experiment with bias coin and also found most kind of participant lost money. So what does it say about the investors' psychology?
Well, so we did this experiment where we gave people money and we let them bet on a coin that we told them had a 60% chance of landing on heads. It was a digital coin, where you did it on the computer. even though participants had a positive edge because they could just keep betting on heads over and over and over, that, we found that they didn't really have a coherent sizing strategy, that they might, just keep betting. Some of them, kind of did a doubling down thing. They bet $2 if they lost, then they bet 4, then they bet 8, then they bet 16. Well, they by that time they would have lost the money we gave them to begin with.
Right.
And what it really illustrated to us is that, people are not really trained or taught about the sizing decision. How do you manage a bankroll like that? How do you manage and of course, betting on a biased coin is different than investing in the stock market. Like in some ways, there's a natural kind of limit on your scaling in some ways, because you could just say, well, I'm going to put 70% of my money into the global stock market, and maybe 90% was optimal or 50% was optimal, but if you did 70, it's not too far from optimal anyway. Whereas if you're doing more concentrated bets like coin flips or using options or using leverage, then the sizing becomes really important. And, what we call the volatility drag, will ultimately kill you. And so, I think the easiest way to see that is that if you're trying to maximize your expected gain, your expected monetary gain, and you're flipping a biased coin, like let's say I give you $100 and I say, okay, you can flip this coin for a day as many times as you want, and at the end of the day, I'll give you however much money you've won. The optimal strategy, if you're trying to maximize your expected wealth, is to keep betting all of your money on heads and hope to make it to the end of the day, or hope to make it through 100 flips or whatever. So you have like a infinitesimal probability of succeeding. But if you do, you have a trillion dollars. And when you multiply that small probability times that huge number, your expected gain is high. But everybody knows that you shouldn't do that.
Right.
Everybody knows that's a silly strategy. So you're not, so we know intuitively that we're not supposed to be maximizing our expected monetary gain. We're trying to monetize like our expected utility or our expected risk-adjusted return, or adjusted, our certainty equivalent wealth, or something like that, something that's taking risk into account, that, it's kind of return. We're looking for the highest return minus the cost of risk. That's risk-adjusted return. And, people just hadn't really been trained or thought about it with regard to like this game of the coin flip. That's what we saw. These were all financially trained people, but they weren't really learning anything about sizing. And, in fact, we looked at the curriculum of some of the graduate courses in finance that they were in, and there was never a module that was like maximize expected risk-adjusted return, and, showing it in a way that they could then, they didn't do enough of it or any of it, but certainly not enough of it to be able to then play this coin flip game and do something that was simple and sensible, such as just bet 10% of your wealth, bet 10% of your bank on each flip, and bet heads every time. Like virtually nobody did that.
Right.
So we learned a lot, and I think that gave us more confidence to go and write the book, and believe that there was some use for the book. That it was going into a gap in our knowledge.
I actually recently visited Newport in Rhode Island, and also see this huge mansion from the Vanderbilt family. Kind of amazed that the wealthiest family in U.S. kind of lost all their wealth in just a few generations. Maybe it's a question to you is how the high net worth individual should calibrate the risk aversion and also spending to avoid kind of becoming the missing billionaires.
Well, yeah, I think when, the next version of the book would be like, if somebody wants to write the book again in another 50, 60 years, it'll be The Missing Trillionaires, I guess. But, I think that, ultimately our wealth is going to be the result of our investing minus our spending, or our investing plus savings minus spending. And, it's really important for people to follow a spending policy that's consistent with their investing policy. So if you plan on just spending a fixed amount of money every year, then you really should have your investment line up with that. Like if your intention is, I just want to spend this amount of money every year, maybe adjusted for inflation, then it doesn't make any sense for you to invest in risky assets that don't match your spending. Now, you might say, well, I'm going to spend a small amount of money for the rest of my life and leave the rest of it for charity or my kids or grandkids or whatever. Well, okay, then we're talking about what their preferences are beyond that. But, I'm just taking a general case where a family is like, okay, this is what we're going to spend, forever, and it's a fixed amount, then having a risky portfolio but a fixed spending policy, is a very dangerous combination. And, in general, I think looking at the Vanderbilts or some other wealthy families, that they kind of got locked into a spending policy that to begin with probably made sense, like that. I don't know about the houses in Newport, Rhode Island, but when the Vanderbilts bought huge houses or built huge houses in New York City, they could really afford them. Or when they had these huge racing yachts or whatever, they could kind of afford them. But at some point, they couldn't afford them. And when they got to this point where it was, that after, to begin with, it was okay. But then when it got to a point where it wasn't consistent with their wealth, they didn't cut back. And then they just, went over a cliff in that way. So, and some of these things just created a long stream of high expenses, whether it's the Biltmore estate or these houses. Like, if you have a 70-room house in New York City, there's a lot of expenses that go with that. And those expenses are going up with the cost of living faster than inflation. And all of a sudden, New York City started to create a property tax, and the same in Rhode Island. And, I think that it was a combination. And then on the investing side, a lot of these families kept very closely held portfolios in the businesses that they got wealthy from. So the Vanderbilts had railroads, and, that they didn't diversify. They didn't diversify out of their core level of competence, and even other families like the Astor family, that was also one of the wealthiest in American history. They made their money originally in fur trading, right? In beaver furs and all of that.
Right.
And then they took all that money and they bought New York City real estate. So again, they were actually very concentrated. They owned a tremendous amount of New York. That's the only thing they owned was New York City real estate, most of it, low income housing. And somehow that kind of blew up at some point, even though everybody's like, oh, New York City real estate, you can't go wrong. Well, there's no Astor trillionaires around today. And, that's because that real estate didn't work out for them in different ways. As remarkable as that sounds, that's like, okay, New York City has not always been the best real estate market in the world. So it's just this lack of diversification, in these very wealthy families, has generally been a problem. And, in some cases it's been okay. Some families have done okay. The Hermes, reading about the Hermes fortune and all of that. Okay, great. That worked out for them. But, in general, I think there's really something about these very concentrated holdings that's very dangerous.
Well, you used to be in the hedge fund investment, but I also see that you kind of change and also advocating low cost indexing. I mean, what drove this kind of evolution?
Well, first of all, I think the first thing to say is that I worked in the hedge, I worked in proprietary trading at an investment bank, and then I worked in a hedge fund. And when I was working at the hedge fund, I invested in the hedge fund, but I never believed that hedge funds made sense for individual families and investors, really. I always thought of it as a product for very sophisticated, very high net worth investors or institutional investors. And, in the beginning of the hedge fund industry, it was these high net worth individuals, but very quickly it became institutionalized. And from a tax point of view, for U.S. investors, hedge funds are not very tax efficient investments. So not only are you paying the hedge fund fees, but you're also paying relatively high taxes, current taxes. There's, some problems, some limitations on deductibility of expenses against income. In some ways, I never really thought that hedge funds made a lot of sense for ordinary investors. But then, I think that over time that I even felt that more strongly. So, maybe, in 1995, I was like, I don't know. I just wasn't thinking much about individual family investing. Like I was working at a hedge fund or I was working at a bank. And it was really only once I stopped working, and was able to start focusing on how to invest my family's savings, that after a little while, I realized that, for a normal, family, that investing in a way that the things that were really clear to me were low fees, tax efficiency, diversification, or maybe it was low fees, diversification, or maybe it was diversification, low fees, tax efficiency, that I wanted those things, right? So as soon as you say you want those things, if you want diversification, low fees, or low frictions and low fees and low taxes, it just takes you to what it eliminates 90% of the different things you could invest in, right? Like once you say those things, well, private equity, it's not very diversified. It has high fees. It's not very tax efficient, so that's out. Or, hedge funds, kind of the same thing. And so if you start off by creating that criterion for yourself, then that's where it takes you. And that's really what happened for me. I was like, the things that I can control, that I don't have to be smart to get diversification. I don't need to be smart. That's an easy thing. I can get diversification. I don't need to be smart to pay low fees. I can do that. I can just choose to pay low fees. And, I can choose to be tax efficient. So none of those things require like great skill or intelligence or anything, but it takes you to a certain place. Now, that's not the end of the story though, right? Like once you say you want those things, you still have other questions you have to answer. You have to decide, how much US equities do I want? How much non-US equities do I want? You have questions over, well, should I own gold, right? Because gold can be tax efficient. It's diversifying, and it's low cost. It doesn't cost anything to own gold. There's different but so then there's other criteria. So I have this other, for me, I have this other criteria that I only wanted to invest in things where I could estimate the expected return. And so I look at gold and I'm like, I like gold. I get that, whatever. I'm not critical of gold, but I really can't come up with a good way of thinking about the expected return. How do I think about the expected return of gold over the next 10 years? I might say, well, it's going to grow with per capita GDP growth. So an ounce of gold will always cost a certain number of hours of labor. Okay, well, that's a model. Maybe that was okay, but it's just not the same as like owning equities that have earnings, and you're like getting this earnings stream. So there were, some other things there that I thought about, and it just all kept pushing me towards diversified investing in public markets, and I felt that the public markets and the private markets, like that ultimately, everything that's private is connected to everything that's public. You can't have that people aren't going to sell private companies at a massive discount to what they could get by going public, right? And so, yes, you can buy a coffee shop at some price, but then it's like, well, you have to run the coffee shop. So it's like labor and capital and all that. But for bigger businesses, like for the small enough business, there can be an illusion with small businesses where it's like, oh, they look so cheap, but that's because you have to run them and it's really easy to steal. It's really easy to be embezzled and all that. But you get to bigger companies, right? Like bigger companies that aren't that far from going public, like they can't be at a massive discount. That why would anybody sell their company to somebody at a massive discount to where they could bring it to the public market with a little more work, right? It doesn't make that much sense.
So the liquidity or the illiquidity premium is not playing a important role in the private versus public, in terms of the valuation.
Not anymore. Maybe it did. Maybe things were different. In 1980s, but not anymore. And I think there's people like Cliff Asness or whatever that say actually this illiquidity thing is like a feature that people want.
Yeah, what Cliff Asness also said that.
Yeah, and maybe actually people are overpaying. Maybe people are saying, I'll take a lower return as long as I can say every year that I'm up 5%. And it's just incredible, right? Like in 2022, when the stock market went down and all these private equity guys were saying we're up. And it's like, come on, guys, there's something really, really wrong here when you're doing that. That's really changing our level of confidence in what you're doing. Like, come on, you're not up, you're down. And if you're saying you're up, you're just doing then you didn't mark yourself up properly before. So anyway, I don't think that there can be times, when different sectors have supply and demand. You can get to a situation where investing in distressed assets is a great investment. But in general, I think all these equity-like investments are highly correlated. And, I don't think that it's kind of possible to I'm going to go over here and do really great in this kind of equity versus that, over short periods of time. Yes. But, it's a kind of stock picking. And private equity is really just not that diversified. I mean, there's a certain type of company in certain industries, certain things are hot, and it's if you have a lot of money in private equity, you are so undiversified relative to owning the broad stock market. But you only find out about it every, 30 years or 40 years or something.
Right.
You only find out, that there's a problem there, when there's a really severe financial crisis.
But is there any role in that case, for the active management for the high net worth individuals? Is there any place for that? I mean,
Well, I think that there's asset allocation. So again, that very few investors have the time, the resources, the patience, the understanding, or the data to sort of calculate the expected return and risk of different investments. So even if it's just U.S. equities, European equities, Asia developed equities, it's very hard for anybody it's very hard for most people to say, well, this is the expected return of these things. This is the expected return relative to tips. This is the riskiness. And I want to manage my portfolio like that. So I think there's very much a role for, there's no such thing as passive asset allocation, right? You can say, look, I want to own all U.S. public market equities according to their market cap. That kind of makes sense, but there's nothing that makes sense that says I want to have 20% of my money in U.S. equities. Once you decide how much you want to have in U.S. equities, using an index fund to own all of the equities is kind of sensible. It makes, that's okay. So there is such a thing as passive stock investing, but there's no such thing as passive asset allocation. That goes back to theory as well as practice, that when we got the CAPM or whatever, it was okay, own the market portfolio, but how much of it you own is on that straight line, is on the capital asset pricing line, and where you are on that line depends on your risk aversion and the expected return and risk of different places on that line. So I think that wealth managers have a big role to play in helping people to have a sensible asset allocation through time. And they also have a big role to play just in education around investing, spending, saving, all of that. So I think there's a lot of value that wealth managers can bring to all families, whether high net worth or affluent or lower net worth, but I don't think it's about active stock picking. And, personally, I just don't really think alternatives make a lot of sense for most families, but it depends, it depends on the family. It depends on the location, it depends on what's available. I don't know. I mean, I'm really speaking about the U.S. In the U.S., I think, families don't need alternatives in the U.S. There's great ways of them being invested that are sensible, low cost, diversified, tax efficient, that are really good. Now, in other parts of the world, it could be different because there could be limitations on what's available. Taxes could be different, et cetera. But that's how I feel about it.
Well, in that case, if we also look at some of the endowment fund, I know that it's kind of different than kind of families' wealth and then their asset allocation. But look at the Yale endowment model. Kind of they embrace a lot of illiquid alternatives, right? We just mentioned about PE and hedge funds. So do you think this model will still hold up in today's low return environment, even for the endowment fund, right? Or the ultra high net worth individuals and the family office and all of that? So what do you think about this model?
Well, so again, let's just go back for a second where I was saying, look, what I want diversification, low fees, low cost, tax efficiency. If I'm a $40 billion endowment, the first thing is that until recently, now this might be changing with President Trump, but until recently, they were tax exempt. Right. So whatever they did was tax exempt. And so what that means is that they should kind of be trying to invest in the things that are the least tax efficient for other people, because they should try to invest in the things that I can't invest in because I can't invest in them. So they're the marginal pricer, right? So they have a better pricing power because all the taxable people are like, oh, I can't invest in that, right? So they don't want to invest in like in municipal bonds that are for taxable people. They want to invest in like the thing that's generating all kinds of short-term capital gains, which they don't have to pay. So that's one. Second is fees. So if you're a $40 billion endowment, you might be able to negotiate fees on a lot of things. You might be able to internalize, you might be able to do things internally very cost effectively because you're $40 billion and you have a small number of people doing things. So the cost equation could be different for these endowments. And then, from a diversification point of view, that it can make sense for them to have all these different things. They can just have so many different things going on because they're so big and still be like 50% in public market equities. So I think that the case that I make for taxable families to be mostly invested in low cost index ETFs and so on, that argument is a lot weaker when it comes to endowments. And I don't know. I mean, I don't really, we don't do anything with endowments, and I don't know that much, about their whole thing. I mean, obviously they have some really challenging governance. There's really challenging governance issues with these endowments. I mean, imagine the endowment has basically got like 12 or 20 people that turn up at these meetings where all of them are like very wealthy investment managers in their own right of private equity. Of distress and all this. All these guys turn up and they're like hedge fund managers and private equity guys, and they're there at the endowment. They're the board, and they're trying to say what to do. And it's like it just must be a very difficult governance situation for a lot of the endowments, I would think. So I don't know what they should do. I don't want to make any strong statements about what they should do, but they're different than my family. I pay tax.
Right.
I pay tax. I don't, I'm not so big that I can get a huge efficiency on fees or anything like that. I don't know. I mean, I do think.
Yeah, so even for that, I mean, if you look at the alpha potentially be generated from this alternative investment vehicles versus the tax inefficiency and also the fee they charge, you think even for say U.S. family or Asian family consider this cost benefit, you would not recommend too much on the alternative investment. Is that your kind of main approach or the advice, or what?
Yeah. I mean, at least for taxable U.S. investors. Again, I don't know what situation is. I don't know what the situation is like for other. I mean, there's so many investors that are kind of not really paying tax. There's a lot of investors that have money that's kind of in offshore centers, and the only tax they pay is withholding tax on dividends of public equities,
right,
or something like that. So I don't know. I mean, I think each kind of environment is different. But for U.S. taxable investors, we did a calculation some years ago, and we could do it right now on the back of an envelope. Where a certain kind of hedge fund needs to make like an 18% return for me to get like a 6% after-tax return. We need to say anything more than that, right? I mean, we need to say there's nothing more that needs to be said than that. Let's see if that number is right just quickly. So, I would say that first of all, the after fee return, right, is 18, let's say minus the 2 is 16, and then that times the 80%. So that's like 23. So that's like takes you down to a 12.8%.
Yeah.
That's like the after fee return, right? But I would have to pay tax on 15% of the return because that 2% doesn't get. So I have to pay tax on 15%. And let's say that I'm paying tax at, let's say I live in California, where it depends where I live, but let's say. Let's say I live, in California or Florida, in between California and Florida. So I've got a 45% tax rate, right? So that's 7% tax I pay. So 12.8%, right? That I said is the after fee return.
Yeah.
But then I pay 7% taxes is 5.8%. So somehow I made the numbers just work out
6%.
accidentally, right? But 18% pre-fee, pre-tax return is 6% to me after tax. Now, if I own the global stock market, and if the global stock market gives an 8% return, right? my taxes on that, my effective tax rate on that is probably like 15% because there's a capital gain component. And I'm assuming that I pay the capital gain, but I'll pay it, in 5 or 10 or 15 years. I'll pay the capital gains. I pay tax on the dividend. So I'm going to get a 2% dividend. I pay say 25% of the 2% dividend. That's 50 basis points of tax. So, 50 basis points of tax from the dividend, and then the capital gains, another 1.5%. So if it's 8% pre-tax return on the global stock market, after tax, I'm making 6% also. So I just need to make 8% in the stock market is the same as 18%, from a hedge fund. And it's like, really? And by the way, it's not that different. The numbers are different in private equity, but I think in private equity, it's going to be like a 15% return pre-fee, pre-tax, or 14%. So like 14, 15% pre-fee, pre-tax. But even that, because the fees in private equity, right, you have the J curve sort of effect, right? So like to begin with, I'm sitting there, I make $1 million commitment to the private equity guys. A lot of the private equity guys are charging me 2% before they take any of my money, I believe. I don't know, maybe that's changed now, but it used to be anyway, that they're charging me 2% on my committed amount before I've even given the money. So like if you work through the private equity thing, like you need a really high, rate of return to get to that same after tax return of investing in equities. Now, if you're not taxable, it's a lot better. If you're not taxable, the hedge fund just needs to make 12% or 11%, probably something like that. And then you're in the same place. But 11% doesn't grow on trees, and in general, the only places that you can really invest in are the places that haven't really shown that they can make money year after year after year, because when an investor can make money year after year after year, they generally kick out the outside investors, right? So none of us are investing in the medallion fund these days.
Right.
Right? And there's all these other ones we've never even heard of that we can't invest in that are making billions of dollars every year, make money every day, but they're doing it with their own capital. And as investors, we can't really get in there.
So how does your client's portfolio look like? How does it look like?
So first of all, we have an ETF for anybody that wants to invest with us. We have an ETF. Yep. So
let's talk about the ETF. What's in the ETF?
So the ETF has a baseline that's about 40% US equities, 35% non-US equities, 25% fixed income, US fixed income. And we change that asset allocation over time depending on the attractiveness of those equity markets relative to fixed income and also based on the risk level. So today, instead of 45% in US equities, we have about 25%. So we're quite underweight US equities. Instead of like 40, 42%, we're like at 25%. For non-US equities, instead of like 35 or 33%, we're like at 40%. So we're overweight non-US equities. And then instead of 25% in fixed income, we have about 30 to 33% in fixed income. So that's what the ETF looks like today. Underweight US equities, overweight non-US equities, slightly overweight fixed income.
How often you rebalance?
So we're rebalancing the portfolio a little bit every week. So every week we're moving it towards the target. So it's like, here's the target. We're always moving it about a quarter of the way towards the target every week. So it's almost like we're rebalancing the portfolio fully every month, but we're like spreading it out over on a weekly basis so that we're not making such large trades. And then, we have the ETF that's, $450 million. It just started in February, but it has a longer track record. But most of our clients have separately managed accounts with us. So they have accounts with us at Fidelity, Schwab, JP Morgan, and we manage those accounts for them. Their baseline exposures are customized for what they want. So they don't have to have a 75% equity baseline. It could be different. It could be more or less. And we customize all kinds of dials for them. So how dynamic versus static, like if they wanted to be quite static or fully dynamic, they can choose that. They can choose the baseline US non-US exposures as well. So they have a lot of flexibility, or we have a lot of flexibility to customize for them. We have about $2.5 billion of client assets altogether. We've been doing it for 14 years now. And we also have an offshore Cayman fund for non-U.S. investors who are not, who don't want to have a separately managed account or who don't want to buy the ETF. But the ETF is now starting to be something that's quite attractive to non-U.S. investors. So we're seeing, some demand coming from the London and European markets and other markets. I think some investors in South Korea, where our book was published, are starting to get interested. And we're hoping when we publish our book in Japan early next year that maybe we'll start to see some demand also come from Japan as well. But the ETF is nice. The ETF is nice. It's liquid. It's tax efficient, pays a dividend each year. But like in most jurisdictions, people can buy it. And but also, as I say, we have an offshore fund, a private fund also that people can look at as well.
Wow, that sounds quite exciting. So you said that the ETF actually started this year, right? So it's relatively short.
It started this year, but it was the conversion of a private fund that went back to 2011. So it actually has a 14-year track record, even though as an ETF, it's only existed since February.
So what's the next for Elm Partner? Any new research or initiative, on the horizon? It sounds like you have a lot of exciting things to do, and
yeah, I mean, I think we charge a very low fee, right? We're charging basically 0.12% on everything that we do. And we don't have a marketing budget. Like we don't have a distribution, we can't like pay for distribution or pay to acquire clients, in the normal way that people do that. Like we at the fee level where we are, we have to rely much more on word of mouth. And that's one of the reasons that we really devote a lot of time to writing research that we hope people will read and come to our website and learn about us and so on. So I think that, we're going to continue to invest in education, webinars. We do a webinar every month or so for anybody that's interested to learn more about what we do. We do a webinar. We get 100, 200, 300 people that come, they ask questions. We talk about our investment approach. We try to explain things. And, I think that what's in the future for us is just trying to grow slowly. Just stick to this area that we think, that we're good at delivering. We don't want to start to drift into other things. And, we talked a lot about alternatives. We spoke a lot about alternatives, Jeff, but, we don't, most of our investors have alternative investments away from us. What we're trying to do is offer to people, if you want some amount of your savings in public liquid markets, well managed with really low fees, lots of diversification, then use us for that. If you want to, invest in alternatives or frontier things or whatever, private things, we can't help you with that, but we don't say you shouldn't do it. It's just not in our, it's not in our area. So we have, I would say that a lot of our investors have different kinds of private investments, but, we're trying to really specialize in this public low cost space.
I got it. So your manager account is, assume is managing a portion of your client's wealth, not the total investable assets.
In general, yes. I mean, we have very, very few cases where we have almost all of the client assets. Very few.
Well, the last question actually for the crypto. So, what do you think? The role that crypto can play in private wealth?
No, I mean, I personally don't own any crypto directly. I mean, of course, these days, if you invest in the stock market, you're going to have some crypto exposure, right? Like, for instance, if you invest in the MSCI index of US equities, then in there is strategy stock, right? And strategy, but it's a small number of basis points of exposure to the whole thing. As I said earlier, when I think about the criteria that I want for investing, right? One of those criteria is I want to invest in things where I can estimate the expected return. I don't want to own anything where I can't estimate the expected return. I don't like to estimate the expected return based on past returns. I don't like that way of doing it. I mean, in some cases, that's the only way that you can estimate an expected return in some things is by looking at the past return.
History. Yeah.
if that's the only way that I can think about the expected return in the future, I don't want to do it. I don't want to invest in that thing. I don't think that's robust enough or satisfying enough or I have enough confidence in. So, I just really want to invest in things where, I can come up with a reasonable way of thinking about the long-term expected return. And generally what that means is that I want an asset that's going to throw off some cash flows that I can estimate so that I can discount them and think about what my expected return is. And so that's, bonds, real estate, equities. Those are the kinds of things where there are these cash flows out there that I can think about. Crypto doesn't have those. Oil doesn't have those, gold doesn't have those. And, I'm kind of at peace with not having them in my portfolio. If I did have them in my portfolio, they would be very small. And so it just wouldn't even make that much of a difference. Like if I said, oh, well, I'm going to have crypto. So let's say I have a 2% allocation to crypto and crypto goes up fivefold. Well, I'm not going to let myself have 10% in crypto. It's going to go up. I'm going to reduce it. And so at the end of that tenfold increase, I might have increased my net worth by 3%. Okay. That would be nice. I mean, every little bit counts, but, to have an extra 3% return, I know that I can get that by not paying a 1% fee on my portfolio for 3 years. Like I can get, like 3% is not that big of a deal to have more money one way or the other, a lot of people are, I don't, so I'm at peace with following this general idea of like sticking to things that have cash flows, so, I think a lot of our investors own crypto. I don't know how many, but, I'm sure a good number of our investors own some crypto for one reason or another, but it's not really something that we think makes sense within our portfolios because we can't really estimate the expected return. I think it's easier to estimate the risk. It's moving around. You can see that. It's always easier to estimate risk than return anyway.
Yeah, very disciplined and also very clear about your investment philosophy, right? So you focus on three things, almost your principle: diversification, low cost investment, and also the tax efficient. So those are kind of very very clear to us. A lot of wisdom that you share with us, and then I really appreciate it. I think time constraint, and then we probably to stop here. But I really look forward for future discussion to learn a lot more from you.
Oh, thank you, Jeff. I really enjoyed our discussion, and I hope it's helpful for some of your followers and listeners. And yeah, we'll do it.
Yeah,
We'll do it
absolutely.
again.
I think your ETF will be something I personally will be very interested, and then also will advise our clients to definitely look into it. And then
Oh, thank you. That would be great. Yeah, terrific.
right. So and also
Awesome. Well, thanks. Sorry.
and also your book. I didn't know that it's already in Chinese, and then at some point we also will share with our clients as well.
Oh, wonderful. Thank you so much. Yeah, that's great.
Yeah.
Terrific.
Okay. Thank you so
Well,
much,
thanks, Jeff.
Victor.
Yeah, I really enjoyed that. Yeah, we'll have to do it again. And
absolutely. So next time when
we'll figure
you're
out,
in Hong Kong or in Shanghai, let me know. I kind of travel back and forth between here and US, and then we'd love to kind of meet you somewhere in New York or some when you're there.
Terrific. Yeah, I'd like that very much too. Excellent. Well, thank you so much.
Yeah, thank you so much. Take care.
Take care. Bye-bye.